Ladies and gents, if you could come through, we'll get started in 5 minutes. If you could take your seats, we'll get started in 5 minutes. Thank you. It's in. Let's go. Thumbs up. All right. Thumbs up from the boss. Good evening. Welcome, ladies and gents. Really, really happy to be the host of this first ever event by 8 Wealth International, Invested in Tomorrow 2025. We're doing it obviously in Singapore tonight, and then we're doing this same event in Hong Kong in 2 days' time, but it's also being live streamed, beamed around the world. We'll have people tuning in from all over the place, which is fantastic. My name is Michael Campion. I will be your MC for the evening. I'm really just here as a friend of 8 Wealth International. I know all the guys and girls really, really well. I've had the good fortune of doing some speeches, some executive coaching, bit of corporate training with the team. I can vouch for them, all wonderful human beings, very, very good at what they do. And I also have the pleasure of knowing all the individual speakers, the guest speakers tonight, on a personal level as well. Again, superb human beings. We're going to learn a lot. You'll get a lot of value from these guys, which is great. So just a bit of housekeeping. The bathrooms are on the right when you turn out. If you need to run out, don't need to put your hand up. We're all grown-ups, all good. The QR code is for you to submit questions as well. So we very much want to keep it interactive, especially in the second half. So this will be a game of two halves. The first half, we will hear from 3 individual speakers, about 20 minutes each. So we'll be here for 60 minutes. We'll then have a halftime break, much needed, with refreshments, canapés next door. We can mingle, we can network for a little while, and then we'll come back in for a Q&A and panel. So you're very, very welcome, more than welcome to submit your questions. I'll get up here later with the iPad. I will filter out all the rude ones, and I will make sure the sensible questions get upvoted to the top. So without too much further ado, a quick game is a good game. I'd just like to hand over to the CEO, Ian Riggs, and also just say a big thank you to Daniel from API Global, who are helping us put this event together. So thank you to Dan and API Global. Ian Riggs, CEO of 8 Wealth Management, he's flown in from the UK today to be with us. He has over 33 years of experience in wealth management. I know he takes a real interest in the lives of all his clients. Super high touch, really, really personable chap, and very, very good at what he does. So please put your hands together for Ian Riggs of 8 Wealth Management.
Thank you, buddy.
Thanks, mate.
Well remembered. Hey, everyone. Hope you're doing well. I am delighted to be here. I love Singapore. Come out here frequently to see clients, get interacted, and we're really, really happy that there's plenty of people here because 5 minutes before 6 o'clock, the girls were panicking. So thank you very much, and please indulge yourself in all the halftime snacks, the after snacks. We've got some entertainment at the end of the night for you. It's going to be brilliant. So my job today is just to tell you a little bit about 8. So who are 8? Common question we get asked. So to give you a broad overview, we are a firm of chartered financial advisors, and we specialize in one-to-one, face-to-face advice, whether that's financial advice, tax advice, mortgage advice, etc. Our area is about building relationships and those unique one-to-one relationships with our clients. We have about 10,000 families that we look after across the Middle East, Asia, and the UK. And those clients we help manage in the region of about 14 billion US dollars. So there's, we're pretty busy helping those people navigate through their financial journey, which I'm going to talk a bit about as well today. And we are a strategic partner of one of the UK's largest wealth management companies, St James's Place, who are currently managing in excess of 260 billion US dollars in the UK. And our relationship is very much about a strategic partnership. They deliver products and services. We look after clients and deliver advice. That is what our remit is. It's all about advice. And the most common question I get asked all the time is, why are you called 8? Now, obviously, 8's a lucky number. Next time you go to the casino, please put $10 on number 8, and if you win, I'll send you my mobile number. You can share the cash with me. It also is it certainly in Asia represents wealth. But that's not really why we are called 8. We are called 8 because our values are really simple. We are looking to exceed our clients' expectations, to inspire those clients to take action, to grow our clients' investments and our proposition, to help our clients whenever they need it, and most importantly, to build long-standing, trusted relationships with our clients. Exceed, inspire, grow, help, and trust. Those values underpin our organization and everything that we do all the time. We're focusing our people on exceeding. We're trying to get our clients to be motivated to take action, and building trusted relationships really is the most important part about our offering. And our group is spread across multiple jurisdictions. So we talked about the UK, here in Singapore, Hong Kong, and in Dubai. And the group is made up of 5 individual entities. So we have our financial advice business. That's our core offering. We have our international business. We're here today representing that international business. We have a tax business, and that's an international tax business. We have a mortgage offering, and that's all mortgages across multiple jurisdictions. And we have our wonderful charitable foundation, the 8 Foundation, which I'm proud to say has 80% of our people making monthly contributions out of their salary, which we match pound for pound. And so far, that foundation has raised over £500,000 for local charities and individuals. So 8 really is a business that we're trying to bring together so that our clients can navigate through whatever their life looks like, and we are there on hand to help them whenever they need it. So I'm going to talk to you a little bit today about our vision. So our vision is straightforward. It is to deliver invaluable life to enable our clients' visions to come to life. And we really do focus on what is your vision as a client? Where do you see yourself in X years' time? What do you need help and support with? And our job is to deliver the advice, to give it to you. Whether you follow it or not, and sometimes people don't follow it, that's absolutely fine. We focus on giving the best possible advice that we can, and underpinned by those 5 values is really what 8 is all about. So ultimately, how do we do that? Now, I know you're going to struggle to read this because I tested it earlier on, so don't worry, it's not your eyesight. The text is too small, right? But we've got 5 key pillars that as an organization we are focusing on that will enable us to deliver what we want to do. The first one is we want to make sure we're developing our people. And developing our people is a really important part of a client-centric business. We don't have assets. Our clients are our assets. So our people deliver the client experience. We want to make sure that we've got high-performing, focused people who are engaged in all of our values. We need to make sure we protect our business. We need to protect our clients, and we need to manage risk appropriately. The third thing is about reimagination. We're always trying to reimagine everything. Is there a better way, a faster way, a more profitable way to do things? And final 2 is the integration of technology in our business is extremely important because it enables us to streamline processes, make the experience that our clients have as efficient as possible. And then finally, for me, the most important one is that we empower our financial advisors with the tools, the knowledge, the skills, the support, and everything that they need, because they're the ones that you have a relationship with. Our job is to give them the power and the information and the support that they need to deliver that financial advice. And the whole business, every key part of our business, is aiming at delivering each of those 5 things all of the time. So what do? This is the hardest one, because I could write a really long list, but fundamentally these 5 probably capture at a really high level what we do. The first thing is we do financial planning, proper financial planning with our clients. What do you need in the short term? What are you looking for in the long term? What's happening with your family? What issues are there back at home? What's happening in your current country? Building proper short-term and long-term financial planning is our main objective. But we do, and I'm going to share a little bit with you today on this, we do help our clients with repatriation. It is a thing. Clients are generally becoming more globally mobile. They are moving around, and we've seen a significant area of under-advice, certainly in the repatriation of clients back to the UK. they're missing tricks, they're paying unnecessary tax, and we're pretty sure that's the same in other jurisdictions around the world. So repatriation, a really important part. Property investments and lending. Our clients like property. They like their homes, they like property for to let, to rent, to holiday, and for their family. So we provide a property advice business, which Dan is going to talk a little bit about today, as well as the all-important access to the money, the lending, if required, to support that property portfolio. Tax advice, critical. You know, we have an international tax advice service. Hands up if you like paying tax. Perfect, you can all be clients, that's good news. Nobody likes paying tax. We like to find ways for clients to pay as little tax as possible legitimately. So using tools, using products, using professional people who know what they're talking about to make sure every client is getting bespoke tax advice based on their personal circumstances. And finally, investment management. Most people think all we do is investment management. It actually is a really important part of building a plan, that you manage someone's money and deliver positive returns. And I'm delighted that Schroders are here today to talk about their views on the current market and how much money they're going to make you with the great tips that Reginald is going to give them today. Is that not right, sir? Thank you very much. But investment management is more than just managing an investment. It's managing your cash. So we have cash management services. It's managing your retirement fund. It's also, if you're in Singapore, managing CPF and managing SRS. And Cheryl and Jess, who are two of our highly qualified financial planners, have amazing skills and knowledge in the area of CPF and SRS. So investment management for us is about money linked to a plan that delivers the result for you. And we believe we've got a fantastic proposition that is as good as anywhere else and ultimately should deliver a better result. This for me is a really interesting thing because we're an advice-based business. That's what we do. Now, Vanguard, who are one of the biggest wealth managers in the world, managing something like $10 trillion, they conducted a survey recently and a big kind of analysis over the value of advice and determined that you're likely to make 3% or more per year in your return if you take advice. That 3% will come as a result of good tax advice. It will come as a result of timely investments in the market. It will come as a result of good products and good investments. And this is our sweet spot. This is what we're aiming at. We're saying we believe we can give value to every single person we meet. I don't think we've ever met anybody where we didn't add some value. We've met many people that didn't want to buy the value, but we gave the value because that's our job. So a bit on our international tax piece is really simple. We support international clients and business owners, and we basically provide support in 4 key areas. Cross-border expertise, really important that we understand how countries work together in terms of tax if someone is being mobile. We deliver tailored advice with professional chartered tax advisors. Those tax advisors can be UK tax advisors, Australian tax advisors, local tax advisors, South African. We are connected to specialist tax advisors in multiple jurisdictions throughout the world. Peace of mind is really important because I know we don't like paying tax because you told me that earlier on, but you want to make sure that you are paying the right amount of tax at the right time to the right people. We'll deliver that peace of mind to make sure that you're secure and you're safe. And we will link tax planning to the holistic strategy. So how does tax planning work with investment management? How does investing in property work with tax? So our kind of holistic view enables us to plug all those things together and deliver what we believe is that all-important, invaluable advice. And very quickly, these are kind of 4 recent, so it's quite UK-centric, so forgive me that, but these are 4 recent examples of things that we've actually done for clients. So in Dubai, we've got an operation. Really, really quickly, if you live in Dubai and you've got a UK pension, you can take all the money out tax-free. Hands up if you knew that. Hands up if you're moving to Dubai tomorrow to take out your pension. People are doing that, right? There is mass migration to Dubai from the UK. 250,000 people are moving to Dubai every year, and some of that, maybe all of it, depending on what your view is because of the tax rules out there. There is not any, yeah? So clients do not know this, right? So how many clients do you think have got UK pensions that they've ignored from when they were with Aviva 20 years ago, who think they can't touch it until they're 65 years old and have to pay 50% tax? Everybody. It's not true, right? We've set up family investment companies. We did a lot of work when the UK government changed the rules on national insurance contributions. So a lot of work in getting people to buy back years at the lowest possible value. And we do an increasing amount of work with Australians and South Africans on, again, that kind of navigating through the complexities of being an Australian in Singapore. I'm going to go home one day. What should I be doing? Working with specialist firms in those areas as well. And we work with Australian and South African tax advisors, and when we need to, financial advisors. We sat in the office today, colleague to my left, South African. I actually said to Michael, how many of your clients are South African? He said, all my clients are South African. I said, so do you need to be South African to talk to a South African? He said, no, you just need to be Michael Booth. So he was quite confident about himself. So that's a little bit about how we have helped. Repatriation, just a quick message here. Really, really simple. There's a six steps you must follow. Number one, plan early. Do not call us when you're about to get on an airplane, or if you're going back to another foreign country that you used to live, or your place of birth, or whatever, tomorrow. Yeah, we need 6 to 12 months notice. If we get that 6 to 12 months notice, we can plan. We can plan the return in an appropriate tax way. We can also make sure that when you land, you've already met your new advisor, wherever that advisor might be. That advisor has built a relationship. We do a coordinated handover. We pick you up at the airport. We take you back to your new home, and then we look after you and your family for the rest of your life. Repatriation is a really important trick that people miss. There's some simple things that people could be doing right now, even if they're thinking of moving back to another jurisdiction in 5 years' time. I mentioned about property and mortgages and the opportunity. We can help. So we can help UK clients. We can help with Singapore property, Dubai property, property in Spain, Portugal, Australia. We can help people who are living in Singapore or Dubai or Hong Kong who've got family in the UK. Children who they want to buy property for. We can help people who are international clients that want to support UK families. We have international remortgage advice. Hopefully you're getting the message. The fact of the matter is the answer is normally yes when someone asks us a question. Can you help me with this? The answer is yes, I can. It may not be today and me, but the answer is always yes in almost every area. And the final few things I want to talk about is cash flow modeling. Hands up if you've heard of cash flow modeling. Very few. So cash flow modeling, these are 3 systems that are out there. I put them up there because you might want to Google it, right? So Voyant, CashCalc, and GoalsMapper are cash flow modeling systems. These are absolutely amazing. They are tools that we use to take you on your personal journey. And they're built by us with you in mind, and they help us basically create a plan, a visual plan, which we share with you so you can look at it on your laptop, and that visual plan will be plugging in everything that's going on in your life. The birth of grandchildren, the moving of a property abroad. Can I retire? What do I need to do to make sure that I retire? It also helps us understand what risk people need to take with their portfolio, what tax they're going to pay along the journey, how much they need to be saving exactly down to the dollar on a monthly basis between now and whenever, how much someone needs to invest in order to give them the outcome they want. We can stress test these tools. We can create events like what happens if something happens to me. Will my wife or my husband be okay? These are incredible, credible systems. And we want all of our clients and everybody embracing the benefits of cash flow modeling moving forward. And the feedback we generally get from clients is it's amazing. I've never seen anything like it. It brought my entire financial plan into a simple color-coded format. And the color coding, by the way, when you use one of these is really simple. If there's a lot of red, you've got a problem. Yeah? So when you first do it, we normally see people sink in their chair because there's a lot of red, but we can press a few buttons, shake a few things up, and show you that you can change that red, which basically means no, into blue or green, which mean yes, you can. And just a few other things about what else is going on in our business. We are embracing technology. It's really important. Technology for us as an advice-based business is going to allow us to provide more accurate, safer, faster, smarter, and concise advice to our clients. You have to embrace technology in our sector, otherwise we will absolutely fall behind. And we're embracing it really simply. We're partnering with big tech firms. Salesforce is our client management system. Monday.com is our operational platform. We use ChatGPT where we need to. We're using AI more and more to drive efficiency through our business. And the reason we're doing it, ultimately, as well as training our people how to adopt it and so on and so forth, is because we want you to have more time with your advisor. That's where the magic happens. You go back to exceed, inspire, grow, help, trusted relationship that is built on one-to-one face advice. That's what it's built on. So our job is to get our advisors building relationships with our clients and get them out doing that more by embracing all things that are technology. We are going to improve the way we communicate with our clients. I was asked earlier on, are you going to do more of these before this even started? I thought it was a great question. And I said, yes, if people turn up and they like it, we should be doing more like this, telling our clients what we're doing, updating them on our services and our platforms. That's what we should be doing. Last few things, because Raf is giving me the nod up there, I can see you, Raf, don't panic, is we are developing our own advisors. Yeah, the industry is shrinking. The number of qualified financial advisors has halved globally. We need to breed new advisors and train them well. And we need to focus on where it's weak. Only 6% of financial planners in the UK are under 30. Yeah, only 0.5% are under 25. What we're doing is increasing those. We've got 15%. Only 16% are ladies. We're at 23, nearly 25% of our advisors are females. And this year we're going to put another 8 graduates through that financial advice program because the industry will have a problem. And that program is diverse, inclusive, and absolutely committed to making a significant change. And my last thing, and I wish I had longer to talk to you about this one, is the lack of financial education everywhere. I've got 3 children. They did not know what a mortgage was, or a bank account, or a credit card until they got a credit card bill, went over the limit, and asked me to pay it off for them, right? We do not teach children. I've even talked to my brother who's got a son in Singapore. He's not learning about financial education. We've delivered 15 financial education programs across Singapore, the UAE, and Hong Kong. We want to be delivering 50, 60, 70, 80 of these education programs. So if you're in a workplace and you think your company could value the employees getting education, talk to us. If you've got children or grandchildren at school, talk to us. We've got an amazing program, and it's a wonderful thing that we love to see. We're going to continue to focus on being better. We absolutely are committed to getting a better outcome for our clients and really laser focused on delivering what we said we would deliver at the start, which is invaluable advice to bring your visions to life. Thank you very much. I hope you enjoy the rest of the show. I'm going to pass back to Michael.
Thanks, Ian. Thank you very much, Ian. Always lovely to hear from you. I know that was the condensed version. Rest assured there will be some time in the Q&A in the panel later on, so you can double-click on some of those things that you might have more questions about. Next up, let's see if the old clicker works. There we go. There's my friend Reg. So Reg and I, we've done some work together at Schroders, another uber-competent human being. He's the head of multi-asset product at Schroders for Southeast Asia, has been for the last 8 years. He has over 30 years of experience in investment management and portfolio management with Amundi, Barclays, First State. And he's here to give us the color and really, I think, assuage maybe some fears and concerns over the macroeconomic outlook. He'll come in with a view, and I'm sure you'll be very happy to pepper him with questions in the second half about the Trump factor and everything else. So please put your hands together for Reginald Tan.
Thank you.
Thanks, mate.
All right. Good evening, everybody. Thank you very much for your time. I'm very happy to be here. I represent the global multi-asset team based in Singapore of Schroders Investment Management. We've been working together with St. James's Place for more than 20 years in the UK. So cast your minds back to 6 months ago when Trump was elected. Seemed like a really good deal, a good thing for markets. Everybody loved it, US exceptionalism, et cetera, et cetera. Today, if you think about that again, you'll say, all right, well, maybe it wasn't such a good idea. And what's happened? Well, we knew it was going to happen. We knew that tariffs were coming our way. We just didn't know how it was going to happen, how it was going to change every other day, et cetera, et cetera. And we are still concerned about it because we still don't know what's going to happen next, right? That's the reality of it. A lot of numbers here on this page. The main thing I want you to look at on the left and right-hand side are the two bars for 2025 and 2026. It still looks okay from your perspective. You look at it and you think, well, look, growth is still okay, inflation is coming down. It's not such a bad thing. Trump, well, he's a troublesome fellow, but still things are still working in the world. The reality of the situation is that it could have been a lot better if he hadn't messed up. And I think that's the truth, and I think we can't really disagree with that. Let me just give you some numbers. I know that looks like a lot of numbers. I'll give you a couple more. So for this year, US GDP growth, we forecasted at 1.7%. But before all this nonsense with tariffs started, we were thinking it was going to be 2.5%. So that's a big hit, 2.5 to 1.7. For next year, we were thinking 2.7, we've cut it to 2.4. So growth has been reduced for the US. And of course, the US is the world's leading economy, which means that it impacts the rest of the world. Now, in terms of inflation, it looks like it's coming down, it's true. But for the US, we were thinking it was going to be 3.1, and it's gone down, and it stayed at 3.1 for this year. For next year, we thought it'd be going down to 2.8, but now we're saying it's going to 3.1. So generally speaking, growth is coming down, inflation is going up. That's a bad combination. That's the last thing that central banks in the world want, because it means they're stuck. They can't cut rates because inflation is high. They can't raise rates because growth is weak. So that's the worst thing possible. Well, that's the reality of the situation. So for now, at least, if you look on the left-hand side, the trade cycle is okay. Shipping volumes have been tracking according to contracts because these were placed some time ago. But on the right-hand side, you can see that the line's starting to dip down. What is that telling you? Is that people are starting to forecast weakness. There's a lot of fear, there's a lot of concerns out there in the world today, and there's a lot of uncertainty. I think that's the main thing, uncertainty. All the good things that you thought were going to happen with Trump, now you're not so sure. Now, left-hand side, everyone knows the term now, Liberation Day. I don't know really what he meant by liberation, but 2nd April was Liberation Day. Tariffs, which were pre-Trump at 3%, on average went up to 25% with Liberation Day. Okay? A week later, he said, well, things are not really that great. The market's down. People are coming to me and saying, well, small businesses are not doing so well. We may not be spending as much, etc. So what did he do? He said, well, let's have a 90-day truce. Let's cut back this tariff. Maybe it's not such a great thing, but the reality of the situation is that now, if we look back on this, we know that this is how Trump works. He throws the worst thing at you, and he uses it to negotiate downwards. And that's what we've learned over the last couple of weeks. So anyway, Liberation Day went up to 25%. A week later, he said, let's do this 90-day truce. And then that's because of all the stuff that's coming his way. People are telling him, lobbyists, etc., it's not a great situation, Mr. Trump. So because of that, we have a reduction in the average tariff to 21%. And then just about 2 weeks ago, we had the biggest, I guess, walk back from the brink, if you want to think of it that way, when he and China, the US and China, agreed on another 90-day truce. And this was the most important one, actually, because the original tariff placed on China was 145%. And it was reduced by 115% to 30%. And likewise, China went from 125 to 10. If you think about it logically, any tariff beyond 30, 40% is actually meaningless anyway, because it just goes up to such a ridiculous number, it doesn't actually mean anything. But anyway, it was reduced by 115%, and that brings it down now to 12%. So overall, if things stay where they are, tariffs are still up pre-Trump from 3 to 12. It's still higher, and that's why we have those expectations that growth will be reduced and that inflation will go up. So this is assuming tariffs, on average, stay at 12%. The good thing about going through this awful exercise is that we all know now that there is a pain point. Trump will walk back from the brink, as he did, because he knows there are many things coming his way that will hit him right squarely in the jaw if he sticks to it. He's going to lose control of the House of Representatives, of the Senate, etc., etc. He won't be able to pass his bills, and dare I say it, his family, as a result, will not benefit. So I think that's the reality of the situation as well. At the moment, though, what we can say is that the labor market has stayed pretty robust, and that's why we still expect growth to be okay in the US. We don't expect that companies will be laying off people. They could be stopping, not rushing to hire, thinking a bit about businesses, thinking a bit about investments, but it doesn't mean that they'll grind to a halt. Because just like all of us here in this room and the world over, we are still waiting, we are still thinking, what can he do next? But we're not panicking because we know that the US consumer is still spending, the US economy broadly is still strong. But as I said previously, the Fed is stuck. Generally speaking, the Fed is stuck. And that's why the expectation on the right-hand side that rates are coming down, that's the green line and then the purple line, the expectation that rates are coming down will not come through. It will not happen. The market is expecting 2 or maybe 3 interest rate cuts this year. Schroders is saying 0 because our expectations are that inflation will stay higher and growth will come down. So people could be a little bit disappointed. So generally, before I talk about this slide, generally speaking, you see what I'm leading up to here, right? The whole idea previously that the US was the place to be, the best place to invest, etc., is now out the window. The idea of US exceptionalism out the window. And you've seen that. People have voted with their feet. They've sold equities, US equities, they've sold US bonds, they've sold the US dollar. It really doesn't make sense, right? Because if you think about 6 months, 12 months, Magnificent Seven, crazy valuations, lots of money, NASDAQ, no problem. But it's a real problem now. So the reality of the situation is that things have changed. And while Trump has been doing all this, other regions, other countries have also decided, well, we can't rely on this guy anymore. We don't know what we're dealing with because he keeps changing his mind. So Europe, incredibly, has done the right thing. Europe as a region, we all know, cannot agree among themselves. It doesn't really have very strong leadership, but Germany has stepped up to the plate. From the recent elections, we have seen a very, very strong plan from fiscal spending, from a monetary policy, also from the ECB, to support, to spend, and this has changed things completely as far as the growth outlook is concerned. So what we have seen is we expect the European economy to recover, and it's starting to gain momentum. On the left-hand side, there are some indicators that are pointing to the improving economic outlook. And even more helpful is that the European Central Bank has cut rates thanks to Trump. So things are moving in the right direction as far as Europe is concerned. And this region, this market, has done exceptionally well from the stock market perspective. I think it's outperformed by more than 20% on a year-to-date basis. It's quite unheard of. We live in Asia, so can't help but talk about China. So that's the other big gorilla in the room. And clearly, we know there are problems there. But so far, so good-ish this year. The economy has held up well. A little bit of consumption coming back. But we don't want to get carried away. In fact, if you look at the chart on the left, the green line shows the interest rates inverted. It's not going up, it's going down. The chart's inverted. And the other line, the black line, I guess, is household borrowings. They should generally track each other, but what that tells you is that interest rates going down, not up, going down, has not resulted in households borrowing more. So there are concerns, and this is obviously a lot to do with the property market and how that's not doing very well in China, which we all know. So let's not get carried away, but I think what this tells us very clearly is that the Chinese authorities are very, very clear about what they need to do. We saw all the measures being implemented by China since September of last year, followed by December, March, etc., etc. So they know what they need to do, especially when you have Trump sort of messing up the rest of the world. And the Chinese leader has gone on trips to talk to Europe, to talk to South America, to talk to Asia about how there can be bilateral relationships away from the US. And I think that's the idea which all of us, even as investors, understand very, very clearly. We are all diverting our resources away from the US. Yes, 10 minutes, I got that. So let's look at Asia. What's interesting in Asia is that the monetary policy outlook is going to be more accommodative. We don't have those inflation problems. And these are all the data points which I have. The blue bars are the inflation targets, and the green triangles are the latest numbers. So you can see that they are all below. In fact, they're all below, at or below the inflation target. So that means that we don't have an inflation problem in Asia, which means that we can cut interest rates. So that's very, very much different from the US. So that's all fine and good now. We've talked about the big picture. Let's talk about investing in markets. First thing is, very clearly, I already said it, US exceptionalism has been called into question. For us, we have been very, very bullish, actually, on European equities since the beginning of this year because we had a very, very good feeling. We're based in London, of course, and we had a very good feeling about where Europe was heading. So that's where we were diverting our money. The next things we need to think about, if you're taking your money away from the US, which is the largest economy, the largest bond market, etc., stock market, you have to look at the rest of the world. So there are things going on out here which are pointing in the right direction. If you look on the right-hand side, generally speaking, earnings revisions are all improving. So it's not just the US, but the rest of the world. I've already spoken about European equities, how we very much like that. Valuations on the right-hand side are cheaper. Sorry, I'm going to run through this very quick because I think we've spoken about this quite a bit already. So Europe has done so well. We're still in it. I'm not to say that I'm reluctant to suggest you buy now, but I think that another interesting place to consider would be the Asian region. So is this the year for Asian equities to outperform? Actually, it's been starting to outperform. So let me give you some numbers. On a year-to-date basis, in Sing dollar terms, the S&P 500 is down 7%. S&P 500 down 7, Europe is down 13%. So Europe has outperformed the S&P by 20%. So 13 for Europe. Next is Japan, 3%, Asia, about 2.5%. So the other two regions are slightly lagging behind. A very clear loser, very clear winner. The other two are just about there. So I think when you are thinking about where you can allocate or reallocate your money, another consideration would be Asia. First things first, valuations are very, very cheap relative to the US. And then if you look at the growth prospects, Asia in green, looking ahead, lots of opportunities out here. We can talk a lot about, it's not just China, it's Thailand, it's Singapore, it's tech in Taiwan, Korea, etc. So there are many, many opportunities. There's always something going on out here. Yes, China is something we need to watch carefully, but I think that there are the opportunities out in this part of this world. Germany, Europe, I've already spoken a lot about. We also like German bonds, moving away from US treasuries. This is something which is going to be an issue over the next couple of months. It's been all about tariffs, and over the last, I think, couple of days, maybe a week or so, it's all about one big, beautiful bill, or whatever he calls it. And that's really, really important, because that's going to be a big issue over the next couple of months. The next thing for Trump, away from tariffs, will be the fiscal spending package. And that comes with bills and tax cuts and how he's going to spend the money. And essentially what you see here is a trend of worsening budget deficit. This is why he's so concerned about interest rates coming down, because the budget deficit is worsening in the US. This situation is going to cause more volatility in the bond market, which at this point is already not in a very good position. So I think watch this space. I think this is a concern for treasuries when you have more talk of the fiscal deficit going forward in the US. We are cautious on credit. We think, generally speaking, that it's expensive in the red area, but we actually do like Asian investment grade. Like I said, first thing just now was that monetary policy is not going to be a problem in Asia. Inflation is not an issue for us. And as we've seen also, there's growth. Growth outlook is better in this region for the next couple of years. So I think this shouldn't be a surprise. Negative on the US. I think maybe what's interesting to point out is that the chart on the left, that is the relationship between the euro and the dollar compared to interest rates in these two countries. There used to be a trend, that green line and the blue dots. If you look at the top there, that's all broken. That relationship has broken, clearly moved away, and that's only because of US exceptionalism, all the concerns about how things are not what they used to be. And finally, I think we like gold. There's no value to gold. It doesn't do anything other than maybe put it on your wrist or around your neck. It's not used in electronics, well, a little bit. Generally speaking, there's no value to gold. It doesn't pay you any yields or coupons. It's only worth as much as the next person thinks it is. But the reality of the situation is that buying of gold has been phenomenal, not just by central banks, moving away from the dollar, moving away from treasuries. They want a diversifier, so they've been buying gold. Not just central banks, but also individuals. And you've seen gold ETFs taken a lot of inflows as individuals rush to gold. And we like it as a diversifier. So we think that's interesting. It's at all-time highs between, I think, 3,003 or 3,004 US dollars, thousand US dollars per ounce. but we think that there's still value to it as long as there are all these geopolitical concerns in the world. So finally, this is a summary slide of the Schroders Global Multi-Asset Views. First things first, I will overlay it by saying that we are moving away from the US. US equities, US bonds, and US dollar. It doesn't mean that you throw everything away, of course, right? There are always opportunities, there's always timing, there's always value when it comes down to certain levels. But the point is that we have moved away because there's all that uncertainty created by Trump, which means that you cannot trust that they will come through, they will follow through with their policies, as we got used to over the last decades. This is a very, very, very different president. He's going to be around for the next 3.5 years, and we don't know how things will change, but we know it's going to stay volatile. So that's why we would suggest, even while we are positive on equities, because he stepped back from the brink, we still like equities because we expect that growth generally is picking up, will continue to be positive, but diversify away from the US into the other regions. Europe has done exceptionally well, we still like it, but Japan and Asia also look interesting. Rates, meaning duration, meaning government bonds, is a bit tricky because you're caught between how inflation and growth are making central banks move in opposite directions. And when you have the fiscal issues coming up soon, I think that is something that can be causing some volatility in markets. Credit, I mentioned that generally speaking, it's expensive, but we like Asian investment grade. The dollar, very clear. Commodities, also pretty clear. Two things about commodities. One is we like gold, yes. The other one we don't like is energy. Why we don't like energy? If growth is coming back a little bit, even if it's positive, it's been downgraded, that means that demand for energy will be falling off slightly. And unfortunately, OPEC has been not very disciplined, so supply has been rising too strongly, and that's why energy prices have been weak. And emerging markets, as I said, if the dollar is weak, generally that means that there are outflows away to other currencies, and Asian countries benefit the most, or emerging markets benefit the most from dollar weakness. So that's it. Thank you very much. Right on cue. And thank you for your time.
Thanks, Reg. Wonderful. Thank you, Reg. I'm sure that's going to provoke some questions for the second half, no doubt. Last but not least, my good friend Dan Earl. Dan has real estate in the blood. He's Managing Director, APAC for API Global. So he's really here to talk about wealth management through the lens of property investing. So please put your hands together for my friend Dan Earl.
Thanks, buddy. Hello, everyone. How are we doing? Right, let me try and work this clicker. Okay, perfect. So, yeah, I'm Dan from API Global, stands for Assured Property Investments. Apologies if I'm talking very fast here. I've only got 15 minutes. I've had to shorten this. Yeah, so look, API, we're the global leader in sort of investment-grade product and building high-performing property portfolios for investors, whether that's retirement planning, succession planning, wealth preservation, passive income usually for retirement is a big one. 16 offices globally, with teams on the ground in London and Manchester when we focus on UK property investment. Where we're slightly different to other sort of investment-grade businesses is we take a commercial real estate lens to residential. Now, commercial real estate is a very, very heavily regulated asset class, whereas residential isn't. So that's really important from a due diligence layer, but also it's ran commercially, right? So we run all of ours to make money. We're definitely not go and buy your dream home. We're all about, essentially, as Michael said, it's, you know, real estate as the investment product, but really all aligned to your strategic goals and as an investor to make money. API is the sort of mothership, and we've got a number of different businesses which sit in and plug in. Where API, once again, it's a full end-to-end holistic approach to this, where we help you all the way along through it, working with our partners, obviously at 8 and St James's Place. Our capital partners arm of the business is sort of £2 million plus stuff. It can be anything from mezzanine financing for distressed asset plays. It can be whole building plays, all kinds of different investment opportunities for people at that level or family offices. GoGo Prop is a short-term sort of loan and asset-backed bridge financing business. Valorim is our mortgage lending business. Obviously, very important to make sure that you've got the right leverage if we're trying to compound at a higher rate. And then Redstone is our lettings and management business. I actually came into the business as an investor to API, so I bought sort of over the 5 years before I joined API, I bought a number of different properties. And so I've got 9 live at the moment. I don't know the name of any of my tenants. I don't want to. Never spoken to anyone about a boiler breaking. It's a fully holistic managed service, which I think is really important, particularly if you're based over here. And then we've got APIX, which is our comprehensive wealth management for professional athletes. So we work with a lot of football players, tennis players. Any of you who like golf, Richard Mansell, who's just won the DP World Tour in Singapore, he's one of our athletes as well. But this is all about, really, they make quite a lot of money during a short period of time and making passive income for them to retire off. So very similar to the type of mapping that we do from a retirement planning perspective. Exactly the same thing, just usually in a bit more of a condensed time. Usually I'm trying to get the money off them before they spend it to save them. Okay, all right, so look, complete end-to-end holistic solutioning here. So where we differentiate ourselves from anyone else in the world is the market research and due diligence. So first of all, from a market research perspective, we're finding the very, very best-in-class opportunities. And, you know, I sit on the Global Investment Committee. We looked at over 1,000 developments last year. We signed up around 12 in the UK. And this is all about, first of all, macroeconomic growth. So what are those growth factors and what's sustainable growth for the next, 10 years? We're looking at supply and demand imbalances, population growth, industry and company migration, education, new transport links, government spend, all these things which create long sustainable growth. And then we go micro. Then we're working with government bodies, other people who've got great positioning in land. So one of our partners is Gary Neville, the ex-footballer who bought a lot of the land in central Manchester, as an example, when he was playing. And so one of our products last year was the W residences there. It took 12 years just to get that planning permission, but really working with that to orchestrate what's actually going to be valuable for a long-term sustainable investment. So if the rest of the market is doing 20% over the next 4 years, and we've drilled it in, and we're right next to train stations, commuter areas, and everything, we will massively outperform that. Land grabbing zone 1. Once we've found the right products, then this is where we take that the commercial real estate lens and this regulated mindset. So what we're doing is we've got 121-point due diligence sign-up assessment, where we're looking at everything from liquidity of developer, JCT contracts being signed, so liability getting passed across to architects, construction teams, builders. Even in our decks that the legals, we're making sure that you're getting 10-year build warranties, so that anything goes wrong with these places, it goes to the developer. 9 times out of 10, we're getting 100% deposit protection. So that's actually better deposit protection than the bank, because the banks will only insure you up to about 85k. If the W residences in Manchester was bombed during build, you'd get 100% of your money back. We're safety first, and we really do protect our investors. And that, honestly, that's one of the reasons why you work with companies like ourselves, is because, it's not like JLL or Savills and people like that who are on massive retainers from these huge developers, where whichever day of the week you walk into their office, they're going to push whatever product it is. What we're doing is really siphoning down to find the very, very best investment grade product and then protecting our investors. Even the legal packs that you'll go through with us will get deposit protection, we'll get in has to be within 5% of build quality. If they're saying it's a Miele fridge, you'll get your Miele fridge. And then it's the investment advice side of things. This is where we work very closely with your 8 wealth management advisors to really come up with a sort of a longer-term plan on what we're trying to do there in terms of the portfolio that you're looking to build. Once you've moved forward, we've got a whole sales progression team which will help you through that, legal support, construction updates, leverage structures, completion phase, obviously the tax planning strategies, which I'll go into in a minute. lettings and management, and then the portfolio optimization piece. So this is really important because what we're trying to do is essentially maximize your returns while aligning to your overall investment strategy. So for me, what I'm doing at the moment is I'm buying as far off plan as possible. Then during the build phase, I've usually made a reasonable amount of money. And then 6 to 12 months later, I'll release equity and buy another one because I'm scaling my portfolio. Some people want to pay that down faster because they want bigger passive income. If you want to sell it, we'll help you sell it. 9 times out of 10, we're saying don't do anything because you're making massive capital appreciation and massive yield. But that we're there to help you with your advisors as your specialist in this area. I'm not going to go through every deal structure, but something that's quite unique for us is when we work as a global master agent, and you get an exclusive pricing at pre-launch allocations through working with your eight wealth management. So where investors make the most money in a project is the first 20% of sales because it de-risks it for the developer. Where developers make all their money is the last 20%. So what we do through our private banking networks and the specialist deal that we have with people like SJP are, you get that pre-launch allocation pricing, right? And so then it gets released out to the open market with all these propcos. So massive, massive wins there. I'll show you some real-life examples of that in a minute. Look, this is a 360 view of a distressed asset play that we do. So I'm not sure how many of you know who Blue Crest Capital are, but they're the largest British-owned hedge fund. We've got a £250 million funding line where we buy distressed assets off banks. Obviously, it's great for investors because we're buying it for the debt off the bank and then able to take it to market for you guys where, next door's paid considerably more than you and you've obviously got much higher yields. This actual developer on the right-hand side didn't pass our DD, and 2 years later we ended up owning the business. Look, what we do, we protect clients. That's what we do. We're called Assured Property Investments. The reason we've been going 12 years and done 2 billion in sales and one of the longest standing actually investment grade products is because we do that. All funds held in escrow, complete transparency, low capital exposure during build phases if it's an off-plan build, and the portfolio optimization piece to make sure that we're taking a long-term strategy on your funds and aligning to your overall investment goals. Look, these are the things we care about. You're never going to hear me talk about beautiful kitchens, bathrooms, floors. Most of our developments will have those things, but these are the things that matter. This is the base level of making money out of property, as well as structure and leverage and all these other things, but these are the things that create growth. I hate this slide. Look, I've done a reasonable amount in this space. I think the key thing here is I'm an investor. I came in as an investor. I continue to buy this product. I always say to my investors, buy what I buy. I'm doing the same thing as you. And look, we have all of the licensing needed in all the core areas and a great support team right across every single phase that you need to go through. Okay, hopefully that wasn't too boring. Now I'm going to talk about the asset class. I'm doing this fast. Okay, so how do I go back? So the first reason why, in my opinion, property is the best asset class, and I know I'm going to say that, but the fact that you get to play with a leveraged asset, outside of all the security that you get and the fact that the two biggest stability pillars with the banks and the government need it to keep stable and keep going, and that it's pretty much inflation-proof. The fact that, don't put 300,000 into your 300,000 property because when it grows by 50K, you're only making a 16% return on capital. Put 100 grand in and make the same and a 50% return on capital, or buy 3, make 150,000, and then a 50% ROI on that. The fact that you get to play with a leveraged asset in property, and what we always try and do is, particularly from an off-plan player, and these are actual numbers of our last 3 developments in Manchester, and as an example, if you're only putting 25% into a property and it grows by 1%, you're making a 4% return on capital invested. So 10% growth is 40% return on capital, right? Let that sink in, because that's really how you make property sexy. That's really how you make money out of property. In these examples, right? So we've got our off-plan development there where you can't see it on there, but it's a 15 or 16% growth during build phase of about 2.5 years. But if you've only invested 25% into that, you're making a 60% return on capital. So you're annualizing 30% return on capital a year. And the way that we work at API, we always look at return on capital invested. And look, you can see the numbers there. This one actually, I invested in a 2-bed here. I put about 100,000 into it. I refinanced at the end of last year, and it bought me another unit. But the key things and metrics here is, if we're only putting 25% into the property, it only needs to grow by 12.5% to make a 50% return on capital. And so if you look at this region as an example, you've got 20% macro growth of the region, and this is all the way out to all the not-so-nice areas over the next 4 years. Even if you stay at the same trajectory as that region and it grows by 10% over your 2 years, you're making a 40% return on capital invested. Look, why invest in the UK? First of all, API support and knowledge. We've got thousands of developments. We drill it all the way down to find the very, very best investment grade product. We'll manage it for you. We'll protect you, so on and so forth. Established legislation. You have the same ownership rights if you're Singaporean as you would as an English person. But the big reason why it keeps going, and we'll talk about this later, there's a housing deficit, right? So there's a 4.3 million gap in units at the moment. So it's all about supply and demand. So the government are currently building about 200,000 units a year. Also, what we're building is about 200,000 units a year. The government are saying they want to build 300,000 units a year. It's never been done. It won't be done. There's a couple of stupid things which have just come out, which I'll talk about in a minute, with how they don't even have enough builders to be able to do it. But even if they manage to do this 300,000 a year, there'd still be a gap for another 50 years. So the fundamentals, if it's the last beer at the bar, right, it's going to cost more money. Then the second one, generation rent. What age do we think the average age of a first-time buyer is in the UK? Any guesses? 35, you reckon? It's a good guess. 38 to 42. So half the market rent. So it's a perfect storm when you actually look at it as an investor. And actually, what our friends of the Labour government are doing at the moment is, that's just going to go up because the national insurance has increased on businesses. So that will get pushed down to consumer products. So the price of bread, a beer, anything will be more. And obviously the capital gains tax has gone up. So that's actually been, compressed. I've gone through the off-plan structures, but the tax-efficient structures in a minute. Look, you've got the fundamentals as well. You've still got a tiny island with 80 million people in it, which is still the 5th largest economy in the world, with the biggest supply and demand imbalances and population that's there. There isn't going to be an oversupply. When you talk about places like Dubai or all these other places where people keep talking to me about, there's going to be an oversupply, right? And if the Russian war ends, the market can tank. And look, the currency wins, so on and so forth. I'm not going to go into this in too much detail. Look, this is a graph this is the whole of the UK, right? Try and find any graph of UK property that doesn't do that. And this isn't what I will show you to buy. This isn't with leverage. This is just the whole of it. If we look at this here, that's 2008. That's the worst financial crisis of all time. That's the Armageddon. And it recorrected a year and a half later. It's safe. It's part of a diversified portfolio, and you should be doing all these things. But I would argue with anyone that this needs to be in it. Sorry, I'm getting told to hurry up. Look, interest rates. Interest rates, the Bank of England base rate dropped down to 4.25%. It's coming down every quarter. Once again, my advice would be buy off plan. It's going to continue to come down because they're going to pump money into the economy. So buy now before lending gets easier, so people will buy. Tax-efficient structures, the best thing that we would do for you is we'd put you in a special purpose vehicle structure if this is your second home. Big things and wins against that is all of your interest, mortgage interest you can write off against your tax bill, as well as all your business expenses. You pay corporation tax, not capital gains tax. And if you're somewhere over here, when you're actually, after that, you only pay your 19% corporation tax, and you can pay yourself in tax-free dividends. I'm doing this really quickly. We can have a longer conversation on all of this. I'm getting told to wrap it up. But very, very tax-efficient structure, which can really work for you as an investor. Inheritance tax, much easier to do the passing and gifting to your kids. there's lots of different things that with regards to this, but we can once again we can go into this on a one-on-one perspective because I want to get to a bit more of a scale portfolio. Okay, so this is really what we do, and if you're going to listen to anything that I've done today, this is it, right? So in this example, this is showing a scale portfolio, rounded numbers, but this is really what we do for clients who want to look at this as a family business. So in this example, we only ever put in £750,000. We're buying 10 properties with a valuation of 3 million. And on average, each property is making £2,000 per month. So you've got about 240K a year coming in rent. So first of all, 20,000 coming in, and then all these other things are tax deductible. So actually, annually, we're only paying 19% this. This is when we're in the scale-up side of things. Then, so this is across 10 properties, and we can build debt into the business as well. If you are migrating back to the UK, one of the things that we want to make sure that we're doing is building loan repayments because you won't pay tax on that. Equally, if you're living in Australia or the US and so on and so forth. So we can even put interest on top of that, but that's all tax deductible as well. These are the 3 ways that you take tax-free income out of it. So your owner loan repayment, if you're domiciled somewhere here, Malaysia, Portugal, all good, basically, tax environments where you don't pay tax across your overseas incomes, you can take tax-free dividends. So my wife has got a list of countries that we're able to live. And then, look, if you are sending your kids to university or anything like that, on their 18th birthday, make them a shareholder and a director, and that will be sort of their pocket money that I give them when they're over there. Right, and this is the main thing that I wanted you to understand from this. So remember, 750,000 we invested here, right? So we've only invested 750,000. We bought £3 million worth of property. On an average of the UK, over 7 years, you'll have made £1 million. So I'll do that a lot faster for you, but we've got a couple of different options. We can sell it, and we'll pay capital gains tax. We can do what I'm doing at the moment with release equity and try and scale and build another 10. You can release equity and buy a boat, or we can start using this to start paying off the debt within this. So usually what we would do is we'd look at the higher yielding properties, pay them off first, so that we've got lots of passive income coming through, and then we'll maybe leave some debt in some of the other ones where we've got bigger capital appreciation. The key thing here is, the idea is you start paying all of this off, and then if we did this over a 10-year period from a retirement planning for passive income, what we would do is we pay into that to then create much bigger passive income. And so, you can be in a situation where you'd have around £350,000 coming in a year with 19% capital gains, corporation tax, and be making about £290,000 passive income. And if you sat over here, you'll be in a situation where you can take that, that's net after tax. Then look, market now. Key thing here, we've got the 4.3 million missing homes, banks lowering interest mortgage rates. This came out 2 days ago. They're saying that they're going to put penalties on builders if they don't develop in time. All that's going to do is the smaller to medium-sized builders are going to start dropping out, so they'll get further away. There isn't even enough builders to go to build that amount. Generation rent. And obviously, internationally, it's one of the best markets because of what it has from a supply and demand imbalance. And then just generally across the UK, if you look at the growth stats, across the whole of the UK, you're talking 22.4. If you look at the Northwest, you're talking about 30% over the next 5 years. Sorry, Raf. Thanks, everyone. Thanks, was that really long? Sorry.
Don't apologize for giving value. So thank you to Dan, thank you Ian, thank you Reg. If you haven't scanned the QR code already, please do so. I imagine those 3 speakers will have provoked some thoughts for questions, so you can submit those to me. I will go through them during this halftime break. We're going to break for 20 minutes. There's a canapé and a drink with your name on it next door. So we'll come back at around 7:55, I believe, and then we'll get these gentlemen up here for a panel. Thank you very much, and enjoy the break. Don't turn me on. Hello, hello, hello. Hello, hello. Hello, hello. Testing, testing. Don? Yeah. Ladies and gents, if you could come back through, we can kick off the second half. If you could take your seats, thank you very much. No need for this. No need for this. There's no need now, right? Good. Okay. All right, mate. Thanks, mate. Ladies and gents, if you could take your seats, please, we can get started. Go. Ladies and gentlemen, please take your seats. Thank you. Wherever you like. Wherever you like. Yep, jump in. Yeah, see what you think. That's it. Just go off me. Right.
I'll leave it to you, whatever.
There's one on Indian equities. Interesting. questions that have come in. If you do not have a question of your own, you are welcome to upvote the question that you believe to be best, and the most upvoted questions I can then put to our panel. So that's a decent way of doing it as well. We good? How are we looking next door? Almost everyone. Okay. I'll be bad cop. All good? Thanks, guys. Someone has to be bad cop. Right, beautiful people. Hopefully you enjoyed the first half. Any questions you have, as I said, you can upload them on the QR code. If you want to go old school and analog, we will have a roving mic as well, if we have time. We're doing pretty well. I think we want to release you guys to the bar and the canapés again at around 8:30, so that's 25 minutes. So roughly 5 minutes per speaker. I'll make sure everyone gets their allotted time and has the chance to express themselves, and anything you've missed, we can double-click on, which is great. So what I'd love to do, the astute amongst you will notice we have a new face, magically appeared on the panel. So this is Giles Henman. Giles is the senior partner and head of business for Asia at 8 Wealth International. Again, wonderful human being. I've come to him personally for advice on wealth management and my own investments, so I know he knows his stuff inside out, really cares about his clients. Giles, I'd love to pick your brains a little bit to begin with, and then we'll work through the other guys. The question I had earlier, again, I think it just keeps coming up. Let's start with the basics, right? For expats in Singapore, how do you approach building a long-term financial plan? One that's proactive, not reactive, taking into consideration all these, international complexities. How would you go about it, building it?
Okay. Hello, everybody. Thanks for coming this evening. I think it's very simple in the beginning, which is starting with the end in mind. Having a good financial plan starts with a goal, long-term goals, short-term goals, understanding that, sitting down with a client, having a very, very open chat about the things that are important to you guys. That's financial planning. Understanding what's important to you. It's very different to what's important to me, what's important to the person next to you. Once we know and understand that, it's about then overlaying all of those other complexities. The country that you sit in today, the country where you own assets, the country where you might retire. I don't know whether you've noticed, but a lot of governments have huge debt. Tax is only going to be going one way, and that's up. Governments are looking at more and more ways of taxing your wealth. It's our job to protect your wealth. And for a good financial plan is creating that path of least resistance to make sure that your money is going to be working as hard as possible for you. So you either have to have less money to give you the retirement that you need, or your money has to work less hard, i.e. you don't have to take as much risk with the assets that you've built. It's as simple as that, but it obviously requires lots of expertise and somebody that works with you that cares about you. And that's hopefully where we excel.
Wonderful. Thank you, Giles. There's the most upvoted question here at the moment with regards to kind of your field of expertise is actually on the growing prominence of AI and how that will evolve. I'm going to take a bridge to get there, though. First, I know personally speaking, the most value I got, there were many things I got out from our meetings, but when I actually saw the cash flow modeled out into the future, what me and my wife have, what we need for our 2 kids, and actually just seeing it color-coded and mapped out gives you that immense amount of peace of mind. How much are we just buying security, buying peace of mind? Planning is essential, even if having a plan can get blown out the water. Where do you see the value of the human touch before we go to AI?
Yeah, well, a good plan is something that is built around you, that you've understood today and you've bought into today. But stuff changes. Stuff changes in your life. The macro environment changes. Countries invade other countries. Countries vote in people like Donald Trump, and then everything that you thought was the case suddenly feels very different. So the big part of what we do is obviously once we've built that plan, it's regular review. So the things like cash flow modeling, which work really, really well, is every time we sit down and review, we go back to the plan. We look at how well you're doing against the plan, whether we need to change anything. And cash flow modeling is a really great tool, amongst other things that we use for those sliding door moments, the turn left, turn right. And what I love is when a client, and there's a number of you in the room today, pick up the phone and say, look, I'm thinking about doing this. What do you think? What's going to be the impact? Now, I can't tell you what you should do, but what we can do is tell you what that action will do to your overall plan. Is it going to make it better, worse, more efficient? Is there a better way of achieving that same result?
Great. And just one more for you, Giles, before we move to the next person. That's it. Most upvoted, so I have to go with the room. With the growing prominence of AI, how will you expect client engagements to evolve?
I mean, I've gone down recently quite a lot of rabbit holes when it comes to AI. I'm into my Instagram.
He lives
and
in
there's
rabbit holes
loads of stuff on AI. I think if we ignore AI in terms of future investing, we're in lots of trouble. I think it's going to have a massive impact on the world generally. I think there's going to be quite a number of jobs that won't exist in the future. I don't think it replaces us. I think it will replace. I'll be replaced by somebody that uses AI better than me if I don't learn how I can use AI for the benefit of our business and my clients. But I still believe when it comes to your money, your future, your financial plan, your kids' future, kids' financial education, sending them to university, people want to speak to a human being for that reassurance. They want to be able to pick up the phone and speak to a real person, not a virtual person. I had a conversation with a virtual person earlier. My wife had a small procedure in hospital, and I was trying to ring her earlier to find out how she was doing, and I was on the phone for 10 minutes until I realised I was speaking to a bot. Genuinely, I mean, it was very good, but it wasn't a real person, and it was the last person I wanted to speak to find out whether my wife was okay. So yes, I think artificial intelligence, we're absolutely invested in it. We believe that it's going to be a big part of our future, but I still believe that for financial planning, for those big moments, the human touch is going to be important.
As do I. As a speaker, I'm kind of dead.
Yes.
Although worryingly, AI has passed the Turing test already, by all accounts. A 10-minute conversation before you realised it was a bot.
Yeah.
Terrifying.
Michael, do you mind if I just...
No, please, jump in.
Just not about AI.
Oh, go.
You know, Giles is the man about AI. This is not really Giles, by the way. It's an avatar.
It's a hologram of Giles.
It cost £2,500, and it's been the best investment we've ever made. He's currently in hospital with his wife, and she's absolutely fine, in case you wanted to know. No, what I was going to say was, to the planning piece, really important. So Mike Tyson famously once said, it's all well and good having a plan until you get punched in the face. That was always his strategy. He said they can have a biggest plan they want, but when I'm punch them in the face, they're going to have to think differently. Our job, when our clients get punched in the face, is to wipe the face, fix it, stitch it up, and move on. And that's where planning, on a human level, can never be replaced, because it's emotional, it's about people, it's about relationships, and there will be people that won't want that, but the majority of the people, we think, need people. Yeah, we are a race that rely on relationships. Yeah, I think we kind of all love each other most of the time, so as long as that stays the way, then we're good, right?
I'm with you. I'm with you 100% of the way.
Happy days.
Reg, I'll come to you next.
Sure.
Proximity. Unfortunately, fortunately for you, I don't know how
That's
tough
okay.
this question's going to be.
Yeah, hit me.
With China plus one gaining increasing relevance, how do you expect Indian equities to perform or outperform their Asian peers versus historical performance? Maybe you can blend that with a view on emerging markets,
Sure.
not just India per se.
Sure, that's fine. That's fine. I mean, India is the largest country in the world today, 1.4 billion people, bigger than China. The middle class, probably about 300 million people, bigger than the US as a whole. Now, more interestingly, think of India as China 5-10 years ago, before China became China of today. So it's still got those legs, it's still got the growth, it's still got the opportunities, and it's doing very well. And that was reflected in the performance of the stock market over the last year or two. When people couldn't get enough of it, it got very, very expensive, and then it got sold down, and people found all kinds of reasons to sell it. But end of the day, it's a very, very interesting opportunity. There are lots of good things going on about it. At this time, also earnings we see to be improving. Interest rates are actually coming down, thanks to Trump again. But that makes it something that we like. If you look at the world today, again back to Trump, lots of uncertainties, trade, etc. India is a country that is sort of shielded from that to that extent because a lot of what is in the stock market is more domestically oriented. So the companies, the businesses within the stock market today are impacted by more about what's going on in the country. It doesn't mean that it's shielded from Trump and all the rest of it, but at least it's better protected than the rest. Other countries. China, we know, it's squarely in Trump's what do you call it?
Crosshairs.
Crosshairs, thank you. And so, yeah, so they're getting, the 145 down to 30 or whatever it is. So that's the reality of that situation. But China also has the means, the wherewithal to find their way out of it. They were the first ones to stand up to Trump. Trump, I don't know if he expected, but maybe he was hoping that they would crumble. They said, no, look, you're going to be around for the next 4 years. We are China, we are the country in the middle of the world, we've been around for 5,000 years. Nothing. So he buckled, and China has said, fine, so now let's talk. And he kept groveling to them. They want to talk to me, and they're like, no, we don't want to talk to you. So now so this is where we are today, as far as China and India are concerned. Very different, but also interesting opportunities always for both of them. As I said before, we think of Asia as one homogeneous whole, which it clearly isn't. You've got these two sort of competing monsters, if you will. Then you've got the tech companies in Taiwan and Korea. You've got Singapore, for what it's worth, right? It's interesting. It's great governance and all those sort of things. So as far as emerging markets or Asia is concerned, as long as valuations are cheaper, as long as the dollar is uncertain, liquidity flows our way. So we see interesting opportunities away from the US to diversify away from the US, just as Europe has done so far this year. Now, let me take a step back and talk about the US.
Does that mean yes?
Yes.
We should be investing in India.
Yeah, I think so, probably.
I just want a binary invest or don't invest. Tell me when not to go.
Straight to the point. Now, back to the US. It doesn't mean that we sell everything in the US. It doesn't mean that you sell all your bonds, your dollars, your NVIDIA and all of that. No, it doesn't. It's still the largest economy, the largest bond market, the largest stock market in the world. It's still got wonderful companies. Yes, we had a deep-seek moment. Yes, BYD is probably outselling Tesla. Yes, all that is true. But as with investors, and I represent Schroders Global Multi-Asset, there are always opportunities in the sea of opportunities. So I think that's the way we would approach it. And I was having an interesting conversation with that gentleman over there. Much as we think that the US is heading down the toilet, there is no replacement for the US dollar. There isn't. You can sell your bonds, you can sell your dollar. What do you buy? You can buy gold, you can buy some Swiss franc, you can buy some yen, some euros, some Sing dollar. It's not enough. So, as with all investors, there are opportunities, you have to pick the right points. Three and a half more years, yeah, I know, but you need to find your points, and there will be opportunities. And it is when you find those, and when you dare to stand against the tide, if you will, I know that's always a tough call, that the opportunities will pay off the best. But yeah, it's going to be a hairy ride for the next 3.5 years. That we know.
All right, well, hold tight. Thank you, Reg.
Sure.
Daniel, I'll come to you, my friend. The most upvoted question, I don't know if you have it off the top of your head. If not, we can go ballpark. But lots of people asking, what's the annual net rental yields on UK commercial or residential property? Well, what kind of yields can they expect for UK residential property? And maybe you can couch that into kind of London versus the other regions, if that's helpful.
Yeah, no, not a problem. I mean, look, first of all, I think you need to make data-driven decisions around where you're going to be. But generally, Zone 1 London, you're talking about 2.5% to 4% max, but probably averaging out around 3%. Manchester 6 to 7%, Birmingham sort of 5 to 6, which actually projected to be the biggest growth market moving forward. I think the key thing is when you're looking at rental yields and where you're coming in is the price per square foot that you're coming in at. One of the reasons why I'm often not advising to buy sort of Zone 1 Londons is the price point is too high, and so the yield that you're actually getting isn't good enough, right? It's very similar to the market in Singapore, actually, where if you're looking at a 3% yield, what we call, if we are doing different methodologies to, I suppose, use the leverage to compound at a higher level, and when we're saying washing its own face, so covering costs of loans and things like that, it's actually very hard in central zones. But yeah, in short answer, yeah, about 3% in London, 6 to 7% Manchester, and yeah, Birmingham's about 5 to 6.
Okay,
currently.
super. And then with regards to the UAE, Dubai, I think attracting a lot of attention from a property investment perspective.
Yeah.
Why are you still so bullish on the UK property market vis-a-vis the Middle East?
Yeah, great question, and I'm constantly asked this. And as a business, we do have that offering, and we do a lot of golden visas and things like that in that area. Look, the big thing for me is the fact that the fundamentals, right? If we're talking about the UK, you've got a tiny island, which is still the 5th largest economy in the world, with only a certain amount of space, but the supply and demand imbalances, right? Dubai, I think there's probably going to be an oversupply in about 3 or 4 years. Whereas the UK, you've got that 4.3 million gap, right? Where they're never going to bridge that gap with where they're sat. And I know I had to rush through it earlier, but they don't even have enough builders to do the 300,000 that Labour are talking about doing there. So, and even if they did hit that 300,000, it'd be another 50-year gap. So the basis of supply and demand imbalances is core to that. Also, leverage structures. One of the major reasons why I'm often suggesting Manchester or regeneration zones in London, where you can get sort of 6-7% yields, is because then you can put sort of the 20 to 25% into the property and compound at that sort of 4-to-1 ratio. That ability is really how if you can be doing 10% of your leveraged asset, and 10% is 40% return on capital invested. That's why, in my opinion. Also, last thing on the Dubai market is we've seen a massive influx because of the Russian war. And like Giles was saying about all these different things can happen. Well, that's actually really positively affected that market, and it's at an all-time high. I would suggest if you looked over the last 40 years, the Dubai market's been sort of champagne and razor blades, and it's at that head. And so if the Russian war ends and a lot of people leave, the market can sort of tank. So I'm not advising it as an investment-grade product at the moment, personally.
Thank you, Dan. Ian, we'll come to you. Look, we've seen a lot of global uncertainty, right? We've been talking about it all evening. What is the number one thing that you think clients most need from their advisor at 8 Wealth?
Good question.
Too good, perhaps.
Question.
I've stunned you into silence.
Thank you very much. Yeah, good question. Well, I tell you what happens, I suppose, which probably is therefore the answer to the question. What happens is we see a heightened level of communication our way. So and we've measured it before. So, tariff times, COVID times, volatile times in markets, whether that's property markets or equity, the inflow of communication to us spikes by 5-fold, because what they want is a cuddle. They want to feel reassured that their plan is on track, and they want to be comforted that it's going to be okay. That's the thing. What we're kind of saying that we're planning on doing, and we were able to do it because we were ready in the UK, and we need to get ready in Asia and the Middle East, was we were quick to communicate and beat that. So us being able to pick up the Trump issue on Monday and communicate that comfort blanket to clients by Wednesday morning actually gave them the comfort, which meant they didn't need necessarily any more. Therefore, that's efficient. They didn't waste their time. We gave them the reassurance. So it's definitely reassurance, hand-holding, will I be okay? The most common question you get when you build a plan, and I know Giles would agree with this, is when you review that plan. So let's say you create a plan, it's implemented. That's right.
And sticking to it.
Someone retires, let's say, and you say, yes, you can retire For the first 2 years of that plan, you have to give that client reassurance that it's still okay. And the first question they always ask is not how much money did you make me, not what was my annual returns, not what's my tax problem. It's can I still be retired? And that is the wonderful thing about the job, because you can make things like retirement and other things really happy for people. So it's cool.
Brilliant. If I can go off script for a moment, and forgive me, I'd love to hear from either Giles or Ian or both of you on a personal level. You're both incredibly passionate about this business. I've seen it firsthand. Why do you love doing what you do? Like, what drives you to keep doing this? You've both done it for more decades.
Rock, paper, scissors?
Right, rock, paper, scissors for it.
Yeah, I genuinely feel privileged doing the job. I do like to be somebody, effectively the CFO of my client's family office, the person they want to pick up the phone to for that reassurance. I do enjoy that responsibility. Things, the period that we've had over the last 3 or 4 months, it's just about the reassurance that you can give a client. Making sure they don't do the wrong thing is sometimes the best value that we can add. People do panic. We all panic when the markets are tanking. I've never heard of the champagne and razor blades, so I might use
I'm stealing that.
Sorry about that.
It's on Oasis's new album, by the way.
Oh, is it? Okay.
Yeah. Great song.
But yeah, it's making sure that, just a reminder, look, this is what we're doing and these are the reasons we're doing. So this is what we're doing and these are the reasons that we're doing it. Your risk profile hasn't changed, the fundamentals haven't changed. Where we are today is noise, and the longer term picture is still exactly what we planned for the future. I'm getting older now, so a lot of my clients are now moving into retirement. That's a huge thing. That idea that when you retire, you're never going to get another salary packet again. Having a plan that you really, really believe in, that you almost put away and forget about because you've got somebody you know has got your back, again, adds huge, huge amounts of value, and it's a huge privilege to be that person.
Beautifully put. Ian?
It's always been the same. Help. Help is in the middle of our 8 ethos. We should always say yes. I got asked at the break, what's the minimum? There is no minimum. What sort of people will you help? Anyone that wants it. That's what it's all about. And it's not just helping the client, to be fair, although they are the most important people. Our people in our business are really important as well. So helping them with a great working environment, with great training, a great culture, helping them, and then them being able to help their family. That's all part of that help kind of family tree that we created. That's the bit I love.
Awesome.
It's awesome. And we are lucky.
Yeah, incredibly lucky. Guys, I think I'm going to call it there because the magic is going to be in the room and in the networking with these guys and the rest of the 8 Wealth team. So if you could please give a round of applause to our wonderful speakers, that would be fantastic. As I said, you've got them. You can corner them at the bar and milk them for all they're worth, right? They're happy to talk. They're happy to help. They're here to advise you. Ladies and gentlemen, it's been an absolute pleasure. Enjoy the rest of your evening. 8 Wealth International are paying for the bar until 10 p.m. Very important. Drink as much as you can before 10 p.m. because then it's on your chit, okay? I know it's Tuesday, but it's a Friday somewhere, if that makes sense, right? Right, I love you and leave you. Thank you, gents and ladies, and see you next door.
Thank you.
Okay, thank you very much.